Welcome, everyone, to the Main Street Business Podcast with Mark Kohler and Matt Sorensen. We are excited to be with you on the Open Forum episode. This is the episode dedicated to the people of the Main Street Business Podcast.
To the people, for the people.
Of the people.
Of the people. Wait, yeah. I need to refresh my constitutional speeches or something. Yes, welcome, everybody. And hopefully you've had a chance to listen to some of our podcasts. But if you are brand new and this is the first episode you've ever listened to of ours, Open Forum, boy, you're in for a treat. Historically, our Open Forum shows are listened to the most, which is surprising for us because we love some of the deep dives on specific topics. But I think people just like to hear what other entrepreneurs are doing. You know, just what are the other questions?
This is like people calling in for car talk, you know, and it's just tax and legal questions, and you get two dudes making up answers. I don't know.
We're just funnier too. We need a Boston accent, you know, something.
Yeah, those guys are great, by the way.
They're our mentors. They're our heroes.
Yeah, they are heroes. Now, of course, we are both attorneys, so when I'm joking when I say that, you know, we're going to try and give you some good tax and legal advice on these questions about how to live the American dream, protect your assets, save on taxes, build a retirement. That's what we are dedicated here to doing on the Main Street Business Podcast.
And I know many of you are thinking, well, this has got to be hyper-focused on tax or hyper-focused on legal. It's going to be boring. No, we are firm believers that your tax and legal is a part of your overall plan, and it has to be integrated and brought together. We are so busy. We are so grateful for many of you that are willing to wait for an appointment. We have most of our attorneys are out over a week, if not a little bit more, and we're trying to create more capacity on our end. But we're busy because people are just like, oh my gosh, I don't have to go see my accountant. I don't have to go see my estate planning lawyer and then my business lawyer and play quarterback and bring them all together and run a play. You guys are my quarterback, and there's different players on your team, or we'll bring it together for you, and we're affordable. Gosh, I had another experience today with someone that paid way too much for stuff. Just
Yeah, I mean, this industry, it's interesting. You know, a lot of people end up going to the lawyer they know that'll do your divorce, your DUI, your personal injury case, and they're going to help you with your business and tax planning. That's careful. All right.
Or
that's like having your dentist do plastic surgery on your nose. You know, I mean, I don't know.
Yeah. Or it's the big firm. The more I pay, the better it should be or must be. Or the big firm has all these things. I met people in the last 3 days, probably 3 days in a row, that just have fallen onto my calendar or plate or text or a phone call that have said, I spent $5,000 to $10,000 on legal work. And I'm for what? We do that same or better quality with this holistic approach for a third of that or less. And they're really, really frustrated in tears. So shop around. Yeah. Don't think just because they're a big firm and they're charging $5,000 or $10,000 for your estate plan. I literally had a text on the way over to the podcast studio today of a woman that went through a divorce. It was brutal. She had set up a revocable and an irrevocable trust. Don't know why yet. I'm gonna try to get her on a calendar. She's a friend of a friend. I'm swamped, but but the reason why I wanted to really talk to her the most is because apparently she spent close to $20,000 with estate planning attorneys. I've never in the history of our firm in 20 years charged someone for estate planning, even if it was 10 trusts, $20,000. It's just in our quality. I put it up against anybody, so I just feel so bad. So I want to try to rein that in. Okay, so
today's podcast is brought to you by KKOS Lawyers, where you can get quality legal advice for an affordable fee. Well, all right. Well, we've got questions here. You got some tips though, Mark, or some stuff in the news? I know we got some deadlines. The IRS is going to want some stuff here in the next few days from you, and there's some nasty penalties if you don't give it to them.
Yeah. Let's do that. Matt and I talked about that. I've got my handy dandy calendar. It's now been shipped out to all those that pre-bought one. Matt, yours is in the mail too.
Excellent. Love it. Looks so good, by the way.
Oh, thanks, dude. It is sweet. Matt finished 2021 MJK monthly planner for entrepreneurs, business owners, tax and legal professionals. It has a deadline of every possible deadline, state and federal. State for entities you might have set up, and then federal tax deadlines for the whole year. Little messages, notes, videos. It's really helpful. Okay, the next big date that we're facing, we're going to try to do this on the podcast in the future, is the 1099 deadline. Now, rules have changed. I shot a little selfie video for social media the other day, and some of you may have already seen it, so this will be a good reminder. 1099s are getting to be a bigger and bigger deal. Think about it, everybody, right? States are cracking down on who's a subcontractor and who's not. They're sick and tired of business owners saying, well, I'm going to just 1099 them rather than do the W-2 thing. And all the states are really hammering down on this. California had even another law passed in the last 18 months to really shove this down people's throats. And they're one of 12 states that are very aggressive. So 1099s is the form that you have to issue for people you paid more than $600 for services in your business that you want to deduct in 2020. Now that's the one sentence definition. A 1099 is something you issue to vendors for which you want a deduction for who you paid more than $600. Now, I've got a lengthy article that takes it off from there. It's on our blog. You can just type Kohler 1099 rules, blah, blah, blah. Get that article because you want to get a W-9. Do I really 1099 Home Depot? All these little questions that come up. You'll want to read the article, so I'll leave it at that. But here's the biggest change. They now have the form. We're all used to the 1099 MIS, M-I-S-C. K-E-Y. But we're interested in the 1099 MIS. Now we have what's called the 1099 NEC, which is the 1099 non-employee compensation form. You have to mail those out to all your vendors by February 1st this year, because January 31st is on a Sunday. And you have to compile them, put the cover 1096 on it, and either electronically or mail them to the IRS the same day. It used to be you had until the end of February to give them to the IRS. IRS is like, too many people are trying to file their tax return, and we want those 1099s out, and we're going to start auditing people that don't claim that income. And people are trying to live under the table. You want to write off, they don't want to claim the income. Too bad. Freaking 1099. Anyway, big topic, but your deadline is this coming Monday. And you can't do this on your own Sunday night online. You have to have a company involved because it's done in duplicate. The electronic procedure to the IRS is tricky. I don't even do my own 1099s. I enlist my staff. And my partners and I have ways of sharing costs. I mean, it's a cost of doing business. So there you go. Anything you want to add to that, 1099?
No, just do what the IRS says. They're starting to get a little more nastier on this one. So, and they've been sending out kind of the warning shots. So this is one, don't mess up. You don't want to lose the deduction. So just be prepared, be on it. Last shot here in the last few days.
What's your update? What do you like in the news? You had something about landlords, didn't you? No?
Yeah, we were going to talk briefly about landlords because we do get a lot of questions and, you know, with all the COVID relief that's happened from, the last round and CARES Act before it, landlords didn't really get a lot. You couldn't get PPP. You can't use ERTC. Those are more payroll employee based. The idle stuff was something that we thought would be a shot for rental property owners, Airbnb owners. Was gutted, you were getting $1,000 at most on that stuff. And then they were only doing it if you had employees, $1,000 per employee. Well, you don't have it if you're a rental property owner. Yeah. So the only things that were really out there, and I was just giving an update to let people know where it stands, is the rental relief. So there is still rental assistance, of course, and that's one I've even used for some of my tenants have had to use it that went on unemployment. If you have a tenant that goes on unemployment, they automatically qualify for rental assistance. There's others that even if
now
they're
hold
just
it.
lower.
Can I stop there, Matt? I love your example. Can you give your person? Maybe you were going to, but I want to ask you now. Yeah. You're a landlord. How did you take advantage of that? Can you give an example?
Okay. So now he applied through his city.
Your tenant.
City actually, my tenant, applied through his city, and the city actually uses a nonprofit agency, a housing nonprofit agency, that's not a government entity, but actually will process this stuff for them. Now, the landlord has to certify and approve it. You have to send a copy of the lease. You have to certify what the rent is, and then it's not paid, and all this. And I'm not gonna lie, it was a pain. But I got a check that's not gonna bounce, okay, for a few months of rent, and so it was worth it. Now, so it's usually gonna be city based. You could, if your tenants or your land properties are in a small city, it might be at a county or state level. But mine are in a large city. The city basically runs and gets that money, manage it, doles it, pays it out. Under the COVID relief, the last bill passed about a month ago, landlords can apply on behalf of their tenants now. So you don't have to wait for your tenant to apply. You can apply on their behalf as long as they've in writing allowed you to do that. So, because some tenants are just, they stick their head in the sand. They're like, you can't evict me. So I don't care. But as a landlord, you're like, no, I need to get paid, man. Like I'm going to jump through the hoops in the paperwork to make sure I get paid. So that is what's out there. It's something, but just be aware of that for those tenants you have that are stop not paying. Inquire if they've been unemployed. There are some income restrictions too if they're still working and maybe they just got reduced pay or something. But they're pretty generous, I think, for most tenants, where a lot of people are going to qualify. They made the income limits pretty high.
Now, can you get back rent?
Yes, absolutely. You get back month's rent. So I got about 2 months rent in one check.
Sweet.
By the time they finally processed it.
Now, one thing that we've talked about, I'm a landlord too. I've got a rental property that I'm trying to get rented by next Monday. It's a long story, but anyway. What I think a lot of real estate investors fall prey to or fall into the trap of is thinking turnkey property. I got this property and now I'm going to let my property manager run it for me. And I get it. I do have property managers myself. But I want to encourage all of you that are me. I've learned the hard way that my successful real estate investors, they're involved. You've got to keep an eye on this. So if you have a property manager, your property manager may be helping facilitate this. You may say, hey, property manager, get over there, have them fill out the damn form, sign it, and then I'll process it here. Or get them involved if they're helping you do it. You're the captain of your ship. And you may have a property manager who goes, yeah, well, they didn't do this. Or get involved. Say, freaking, I'll drive over there. And I know some of your rentals, my rentals are in other states. Get friends or family or contacts that you have to go help you track down the tenant and say, we need your help. We want you to pay rent. And I think I think a lot of tenants are thinking their landlord is mad at them or is going to do something bad to them. But I think if you go to the tenant and say, hey, let's work together. Let's solve this together. Oh my gosh, you don't think they're stressed out? They are, just if not more than you.
Yeah. Absolutely. So, I mean, we'll see what's going to happen. Biden has some, there's some news on eviction moratoriums being extended and things like that. But
and more money for rental assistance.
And some more money. Right. I think right now it's slated to go out through March. So hopefully we can see some more funds coming out that way too.
Yeah. Good tip, Matt.
Thanks, sir.
All right. Yeah. And I think a lot of you, if you just go, Matt and I haven't written an article on this rental assistance thing, and maybe we should, but it's so city, county, state specific. And it depends on the type of tenant you have and all that. So maybe we can just do a summary article to kind of point you in the right direction like this last 4 minutes was. But just get on Google. You can find the solution in your area quite quickly. All right, Matt. Well, it's open forum. For those of you that have not taken advantage of this, you can go to mainstreetbusiness.com and right on the front home, first above the cut page, right there, it says, have a question, submit a question. Do it right there. We are looking at those right now, and we're going to reply and say, hey, we answered it on this and such show. And sometimes we can't get to all of them. And sometimes we choose one that we know is going to knock out several birds with one stone. So be patient with that. But Matt, do you want to choose the first question? Let's see what we got going out there. And we love where you're from. Yeah. Your first name and where you're from. It's so helpful. It really makes us a family.
I think, these people are starting to give us that. I appreciate it. They're listening. Yeah. This is for Lee. I'm going to start with Lee because, he gets to go to the front of the line.
Lee. I love Lee. Yeah. Okay.
Always got some great questions. This is, of course, an IRA 401k one.
Surprise, surprise.
So yeah, so he asks, so he has a 401k that we help set up. He has an S corporation, which is generally the entity of choice for small business owners with an operational business. He says when making the company contribution, when a company makes a contribution, not the employee, he says, does it report it on a W-2 on line 12A? Follow-up question, when transferring the money from traditional to Roth, where is that reported? Okay, two great questions.
Yeah.
When you contribute on the company side and you're an S corporation, that is not on the W-2. Only the employee contribution, which whether it's Roth or traditional, is on the W-2. The company contribution is on the 1120S tax return. There's a line for employee benefits. I think it's line 18. I don't know if they've changed it for this upcoming year. I was just looking at the prior return. It's line 18. That's where you're going to put the company contribution because it's an expense to the company on the 1120S.
And again, back to my principle of that you're the captain of your ship. A lot of accountants, they may not ask for this. They may not know, did you actually make this contribution? And let's back up even further. What's cool about a subchapter S like Lee's, he's the only owner-employee, which is a large majority, or I don't know if I'm going to say majority, but a large cross-section of our clients. They're the only employee. Maybe their spouse, maybe their kids. And so here's the cool part. You don't have to make the contribution to the 401k for last year, the company contribution, because it's not on the W-2. You don't have to make that contribution until the day you're ready to file the tax return, if you choose to do so. And you can do an extension and push this till September. So the problem is you got all this time to make and you can choose how much you want to do based on an equation, based on how much you deferred or your W-2. So there's a little bit of math. It's not bad. And you maybe call us and we do consults with clients on, hey, what do you want to do and how much is this, that, and another. But anyway, the point is your accountant may not know that you followed through with that because that's not an accounting function. That's an investment function. So if you decide to contribute to the 401k, which if it's a solo 401k self-directed, you're the trustee. There's no Merrill Lynch in the middle there. So if you put money in that bank account, which we love, you got to tell your accountant. They say, hey, I made a contribution to the 401k for last year. Don't forget to put that on my return. You don't know how many people were doing their tax return for 2020 now, and they go, well, I made a contribution last year for the 401. Well, what the hell? You got to tell us that it was for 2019. We don't know. So, stay involved. So, Lee, this is good.
Yeah. So, you're right. So that should be an expense. So, in fact, it should be on your, your P&L or, however you're tracking your income and expense. It should be a line item on your expense. So your account would know to pick it up out of your bookkeeping to throw it on as on your company return here. Now, the question about we say transferring money from traditional to Roth, where is that reported? Now, let me say on this, I'm going to use some different words. That would be a conversion. So you would, this is the technical term here. Okay. All right. Mm-hmm. So the convert from traditional to Roth. Let's say you had 20,000 that you contributed. Maybe it was the employer contribution here that's in a traditional account in the solo K, and you want it to be Roth now. Okay. Well, that's going to have to get taxed, right? You just got an expense and deduction for it effectively from the company. So to make it Roth, you have to do a conversion, and the plan will need to 1099 you. You will get a 1099-R for $20,000 that you will pick up in taxes in the year you convert. So that's how that works. You're going to get a 1099-R. If you have a solo K at directed IRA where we custody your solo K, we do the 1099-R for you. If you do non-custodial where you control everything and you have the bank account and everything, there's a fee for it, but we can help with 1099-Rs for people doing solo Ks when you do a Roth conversion. But you do need to report that, and you want to kind of report the sum of what you do over the years. So if you do a conversion now and you might convert some later, just do it all at once. We do one 1099 at the end of the year, totaling it up.
Now, what if you do, Matt, I've got to ask you, and you know what's funny, people? I tell our attorneys in our office, I'm like, you have got to listen to the podcast. I learn something new every week. I love listening to Matt because he's such an expert in this area. It's like kind of, if you think of the car talk guys, Matt might be the muffler guy and I'm kind of the engine guy or whatever it is, AC versus heater or whatever. And it's kind of like we take the car apart and we're, yeah, the muffler's an important part.
Okay.
Because guys in these small towns, they want loud mufflers. I don't know what it is. There's a lot of broken mufflers in these small towns in America. Apparently, the noise of your muffler is a reflection of how tough you are.
I just, it's just good that that's how you see me. Sometimes you don't know how the people in your life that you love see you, but now I know. Mark sees me.
I don't know why I said muffler.
If you were a car guy or a mechanic, what guy are you? You're the muffler guy.
Dude, is that your spirit animal? I don't know why I said muffler. Come on. All right.
And then you self-identify as an engine guy.
I'm the engine guy. Yeah.
Like, engine guy, muffler guy.
Come on. There was nothing meant by that. Maybe I should have said I'm the windshield wiper guy.
I'm gonna let it go.
Yeah, I'm the windshield wiper guy. Of course, I can't even change my own windshield wipers. Whenever I go to AutoZone, I'm like, can you come out and put these on? Because like, you're that stupid? Yes, please. I always cut myself when I do it. Okay. Where were we? What were we talking about?
Solo Ks.
What's something I'm going to learn? Okay. Can I convert inside my 401k to a Roth? And what's the form for that?
Yes. So you will want to do what's called an in-plan conversion. This is just an internal form for your own record keeping. Like, let's say, your IRA or 401k was at, Merrill Lynch. You're going to have an in-plan conversion form. You're going to have to elect it. So we have one in our Solo K binder that you get, your own one you can fill out when you're doing that. We also have one at Directed when you have an account like here that we custody and hold your money, and we'll actually process that internally and then do the 1099.
Yeah. Isn't that cool, people? That you can convert to a Roth in the IRA world, and then inside your 401k, Lee, you could say, "Oh, I'm going to chunk at this. I'm going to do a little conversion inside the 401k." This is where people call it the mega Roth, is because you'll do your contribution in Roth, then you'll do the company contribution or match, and then immediately convert that to Roth. And so now you're doubling down on this huge Roth contribution for the year. Is that sometimes what you hear?
Oh, yeah.
Right?
Yeah, I love that. And that's the flexibility of the Solo K. One of the cool things about it is you can go traditional, you can move over to Roth, you can do a little bit of both. You want tax deductions this year, so you go traditional. You got some extra cash, you can pay some tax, you go to Roth.
Yeah.
It's flexible.
Okay. Well, next question. This is from Jed in Utah. He says, I've heard you mention several times that an operational business that also owns its own building, for example, a dental practice, should keep the operations and the real estate in two separate entities. So everybody think restaurant, building, dentist, building, lawyers, building. One of the best rentals we recommend to clients to buy is the one you're already renting from someone else. So if it works in your demographic, your age, your finances, your part of the country, that's one of the first rentals that we want to consider, is because you're going to be your best tenant. So again, if you're paying rent to someone else in a commercial scenario, see if you can make a play to buy the commercial building. Okay. Now, he says, I understand the liability benefits of two separate entities. One, the S Corp for the restaurant, the LLC for the building. Just adding to his question here a little bit. But he says, I'm curious, is there any tax advantages in the case where the ownership structure is identical for both? That is, the partners own equal percentages of the operations and they own equal percentages of the real estate. So equal percentages of operations, equal percentage of the LLC owning the real estate. And he says, is there any tax benefit? Yes. Now, I want to say in some ways that it's nominal, but it can add up. So I don't want you to think it's a huge tax windfall. I would say the primary reason you're doing it is for asset protection, because if something goes wrong in the dental practice, the building's owned by someone else. Seriously, if you go to an Applebee's and you slip and fall, you're suing Applebee's. But I'll guarantee that building is in a separate holding company with a lease to Applebee's to run it. So you're not going to be able to touch the equity in the building. You can just touch the operational restaurant or dental practice. The second benefit of it, really, even before taxes, is that you got an exit strategy. We have a lot of clients that sell the operations of their business, but keep the building and rent it to the buyer of their business. Or they keep the building and do something else with it. Sometimes people sell their business and the buyer doesn't want their building. So I like that separation as an exit strategy, because really you're building two assets, one for operations and one for holding. So keep that mentality. But tax-wise, why is it a benefit? The first one is, and this is primarily the biggest, is that you are now paying rent to an LLC that owns your building that turns your operational income into passive income, just by definition. So when you pay rent to the LLC, you're like, boom, I just took it out of self-employment tax world. It's now a rental property LLC. And the same money can go over there and then fall right out the bottom. You're just funneling money, some may say laundering money, from the operations through your rental property that you rent from yourself and pushing it out. Now, there are limits. Some people go, well, cool, I'll just pay huge rent and wipe out my income on the operation side. No. The IRS is privy to that. Their computer systems are going to pick up weird percentages of rent compared to gross revenue and the type of business you are. Their computer system knows what typical rent is for a type of business of yours based on the data, the massive amount of data that goes through their system. But in summary, you're going to convert operational income to passive income. You're going to want to choose fair market value rent, and maybe a little bit more. You can be a little aggressive, just don't get greedy. But you're going to do fair market value rent and a little bit more. Probably do a triple net lease as well. Really give your landlord a kick A agreement, which is you. And as long as it's common and it's not out of the box, it's going to be okay. So you pay that rent over there and you convert it to passive. And that's going to reduce the amount of salary you have to take on the operation side and the amount of self-employment tax. And that's probably the biggest tax benefit. I have one other one, but Matt, what would you say about that structure?
Yeah, I mean, that alone is pretty nice in that you're expensing out of your business and you're picking it up as income, but now it's rental income as opposed to ordinary income over in your operations side. And then, of course, you're paying down the debt that you owe on that building. You're getting an interest deduction for the mortgage interest you're paying over there against that rental income that you're paying. So it's kind of like a perfect domino effect on what happens when you do that. And at the end of the day, you pay down that mortgage and that property that you would have been paying some other tenant for. It's the same thing of why people are like, own your own home, own your own business location. Like the office I'm in here right now, Mark and I own this. This is an office condo in a bigger building that we own. Oh,
yep. And I'm on a, yeah.
I at least some more space, so let me be a little technical. The next
one. And on that note, the building I'm in right now, if you're watching us on YouTube, because this is simulcasted to YouTube as well, I'm paying month-to-month rent here, and right now I'm waiting for the building permit, and I'm building a shop/building across town, and my mortgage payment on that shop that's going to be 3,000 to 4,000 square feet compared to 1,000 in here, is the payment on that is going to be less than my rent here. And I'm going to be paying down the mortgage, building equity on another property. So I've been in that process for about a year trying to get that deal put together. But so that's another benefit. It's an economical decision. It's just smart economically.
Yeah.
So Jed, go for it. All right, Matt, your choice.
Right. Okay, this is from Roth in Hawaii. Okay. He says he's awesome. We've had the pleasure of meeting Roth and working with them. But he says, from Hawaii, never miss a show. Love you guys. Easy question. When is the best time to add the board of advisors directors for your LLC? When does it make the most sense? I have advisors in Florida, Georgia, North Carolina. I want to add them before I start traveling this year. I like where you're going with this. He says, thanks, guys. P.S. Mark, waves and monsters await. I'm not sure exactly what that is. And he says, Matt, let's get Cobra Kai season 4 here already. Yes. I think I just watched season 3, by the way, which just came out recently. Have you watched Cobra Kai at all yet?
No. And I am a karate dude. I love boxing and karate,
but you can get sucked into it. There's some good drama there.
It's a quality family show.
Season 3, I don't want to spoiler. It's too big of a spoiler. Allie comes back. What was her name? Elizabeth Shue. I forget her name. The
Yeah, in
actress.
the original Karate Kid.
Yeah, that was the girl that Johnny and Daniel, LaRusso, they fought over. She comes back in season 3. Pretty sweet. I just got to that episode.
Yeah.
So, all right, now to your question though, Roth. When's the best time? Now. It's like, when's the best time to plant a tree? Yesterday. You know what I mean? So I just get it done now. Now, if you do have some travel and maybe you're doing your annual minutes are coming up, your company's renewing, which, by the way, we do have our company maintenance special right now. I'll come back to that where we do your minutes for you. But it's a great time to just add into your minutes. Maybe if you haven't added it in yet to your entity, your board of advisors in your LLC, or establish a board of directors in your corporation, it's a great time to do it when you're doing your annual minutes. Throw it in there, add them in, identify who they are. And remember, for your board of advisors in particular, they're just advisory. They're in an advisory capacity. They don't have authority or anything. Don't think of like the board of directors you hear about in these fights in corporate America, and the board of directors is fighting with the shareholders and stuff. No, these are people that are just advisory, and that's what we're going to put in there in terms of their role. But they're involved in your business, and then when you're meeting with them, of course, it can become a valid and legitimate business expense when you're meeting with them for business purposes.
I love it. Now, I want to add a couple thoughts. First, Rafael says, waves and monsters away. I think he means waves and rock stars, because I'm a rock star guy, not a monster. But we've got to get over to Hawaii and do some surfing, that's for sure. I'm actually going to say this to everybody on the show right now. Pay attention. If you're multitasking, listening to something, stop your conversation and listen to this point. This is a saver for every one of you on the show. Everybody should have a board of advisors. I don't care if you don't even have your LLC yet or your corporation yet. You're in startup mode. You're thinking of an idea, or you've been in business 30 years. You can establish a board of advisors tonight. It's that easy. You don't have to go file anything at the state. You don't have to file anything with the IRS, but you do have to document it. So you pull out a pad of paper and you go, here. I call a meeting to order. Do it on Zoom. Do it when you travel. Do it in your home with your friends and family, whoever it is. Here I call our first meeting. I hear, blah, blah, blah. And here's who my board of advisors are. I plan to set up an LLC. I plan to set up a corporation. They'll be more formal down the road, but you're my board of advisors. By the way, eat all the food you want. It's a tax write-off while you're here. And we're going to talk about my business, my plans, and I need your help. Being an entrepreneur is lonely. So you're going to say, I need your help. You board of advisors are here for a reason. It's not just a great way to write off my board meeting at 4 o'clock on February 7th, Super Bowl, in 2 weeks. You don't want to hold your board meeting at halftime. You want to have your board meeting as a legit opportunity to get the help of others, to help hold you accountable, to share your ideas. So I love what Matt said. When's the time to start it? Yesterday, period. And it's a tax write-off. Mm-hmm. Yeah. All right.
Okay. I got one here. You ready?
Yeah, go ahead.
Your turn? My turn? Can I go? I got two for.
Yeah, you go. I talked. You go.
All right. Okay. This was Jamal from North Carolina. He said, quick question. The first iteration, what's up, Mark and Matt? Jamal from North Carolina. Quick question. The first iteration of the CARES Act had a provision where SBA loan payments would be made for 6 months on behalf of the loan holder, which was pretty sweet, right? The SBA was paying your SBA loan for you if you already had one in place before the CARES Act. Does this new legislation include that as well, or some variation of it? Thank you and truly appreciate the show. Yes, Jamal, I've got good news for you. And this is going to go into effect in February. The COVID relief bill, kind of this follow-on one that got signed into law about a month ago, does include an additional 3 months, I believe, payment relief for those with SBA loans. So if you got the first relief where they covered 6 months worth of payments for you on an SBA loan, is automatically going to apply again starting in February. So you'll get, I think, February, March, April of loans covered. So yes, you're going to get that. I don't think it's another 6 months. I believe the extension was for another 3 months, but it's going to go into effect like last time. You don't apply for it. You don't ask for it. They just automatically do it.
Yep. Now, there's actually a 8-month provision for those in certain businesses, and those loans are covered for a certain type of industry. I'm going to keep searching for it while we're here on the show, and just hold that thought, because there is actually a greater than 3-month provision for certain types of businesses. So we'll get to that. Well, we'll come to it in a moment. Let me bring up the next question as we investigate that story. I liked this question here. Okay, hey guys, I'm Evan, a hair colorist from Philadelphia. I recently moved from New York City and still travel there 1 day a week to see clients at what I expect to be a temporary job location, potentially ending this year. I've been writing off bus fare, car rides, travel, because as I understand it, this is not considered commuting since this is a temporary office location. Am I correct in this? Also, am I able to expense any meals for myself on these days? The answer is yes, yes, and yes. But there's some other concerns I want to bring up, Evan. So, Evan, love it. Look at what Evan did too. Let's step back for a minute. And this is what I love talking about with clients on our consultations, and we really encourage our tax lawyers to all take this perspective, is let's look at the big picture. New York City was probably the worst city to be in for COVID in a lot of ways, right? It was just shut down. It's been the epicenter for so much legislation. It's been really difficult to survive there as a business, especially as a small business. And forget it, hair salons, right? Oh my gosh, it's been devastating, right? So Evans said, I'm moving to Philadelphia. That was probably a good economic move. Maybe he's saving money where he's living. He's got a new opportunity. He's out from under the umbrella of New York regulations. And it doesn't mean New York's bad. It was just a good move for Evan, to try to adjust to the pandemic and the climate. So when he travels back, that's absolutely a tax write-off for a temporary location. If you keep going back to a location for more than a year, new different sets of rules start to play into it. So I won't go there. It's challenging, because then the IRS starts to say, well, hold it, that's a second home. It's not temporary. So you kind of have this year to get your crap together and decide, am I going there on a regular basis? And how frequently? And there's some other rules to consider. But right now, the way you phrased it, Evan, I love it. Your meals, your travel, your hotel, whatever you're doing along the way to get there, make money, and come back, all a write-off. Those meals are now 100%, by the way, which is a wonderful bonus, which would have never been the case for the last 40 years. So that's a benefit to help the restaurant owners. See, what the IRS is doing is saying, hey, well, Evan's here. Benefit a restaurant in the local area of New York. Give you 100% write-off. So it's again, tax legislation trying to stimulate the economy. Here's my concern, Evan. You've got to realize you're going to have a target on your back from the New York State Tax Commission. Plus, if you're going back to the 5 boroughs, you've got the New York City tax. And for those that don't know, this is a whole other level of city tax that applies to those in the Bronx, Brooklyn, Queens, New York City, and Staten Island. Those are considered the 5 boroughs. So they're going to say, hold it, you're earning money in New York. You got to pay your fair share of taxes on the money you earn in New York. So you would have to file a non-resident tax return in New York, in the city, track your expenses for that, and blah, blah, blah. So talk to your accountant. Some people, where it's de minimis, are able to not claim that income and just get in and get out because it's a once a year thing, and it's just not enough nexus is the technical term. Sorry to throw out some of those, but just be cautious, Evan. New York's going to want to tax you if you're going to play in their park. So,
yeah, I don't think anybody's surprised by those words. New York is going to try and tax you.
yeah. They're like,
that's
yes.
not the greatest revelation, but it is true. All right, let me get to Jeffrey's question. This is from Washington State, by the way. He says,
Go Hawks, baby. Go Hawks.
Yeah, they're out of it, right?
Yeah, but I'm from Washington. I'm wearing my Seahawk blue today.
Oh,
also,
that is?
The ladies say this blue brings out the color of my eyes. So
do they?
Okay. Yeah. This sweater is famous. I had this sweater for a while. My brother, this is so funny, dude. I know some of you ladies are going to be disgusted, but my brother in college, I'm not kidding, Matt. I think I told you about the kissing sweater. Did I ever tell you about that story? Oh my gosh, it's classic. The Kohler family reunions, this is a good one. My brother in college, he literally had a sweater that whenever he wore it, he got a make-out session somewhere. I mean, it's just once he kissed 3 girls in the same day wearing that sweater. I mean, his roommates started to say, "Dude, can I borrow the sweater?" I mean, it was legit. So
Got magical powers.
it did. It did. It had magical powers. This blue, magical powers. So a lot of my fans, they're going to watch this on YouTube because they're like, "Mark's wearing the sweater."
Yeah. Okay. All right. This one's going to be
throwing
good.
that up. Okay. All right. Go ahead.
All right. Okay. All right. Back to Jeffrey's question. More important things over here. He says, I've looked everywhere but can't find anyone talking about this. My question is mostly asset protection. Single member LLC for a home office business. He says, I'm very strict about keeping personal and business expenses separate for asset protection. However, I use vehicle 80% business and 20% personal. When paying for auto expenses and vehicle loan payments, which account, business or personal, should I pay for these expenses? Or do I pay auto expenses with my personal account and then reimburse 80% of those expenses from the business account to my personal account? All right. Okay, Jeffrey, let's hit there's kind of 2 little things going on in here. First of all, the single member LLC. For a home-based business, and I don't know what business you do here, but for a home-based business, the single member LLC can make sense, but I presume it's just flowing through to you personally on Schedule C on your tax return as a sole proprietor. Now, I don't know the income, but generally for those of you with a single member LLC, if you're making $40,000 or more of net income after all your expenses, we will generally make an S election to that single member LLC, so you're taxed like an S corp. Go to our prior podcast, The Power of an S corp or Benefits of an S corp, for a whole hour-long discussion on why the S corp is the way to go for small business. Basically, you save tax. As to your question, though, on tracking your expenses. Now, this isn't in Jeffrey's question, but the first thing is you can take actual expenses or you can take mileage. Most clients are just going to take mileage, which is around, 55 cents a mile? I don't know where it's at right now. And so, Jeffrey, you're just going to track how many of your business miles do you have versus personal miles. And then, of course, and you may know this, I'm just framing this for everyone, you're going to take a deduction for the miles you use. If you drove 10,000 miles on the car and you 55 cents, you're going to have a $5,500 tax deduction for your auto. And that takes into account the auto expense, the vehicle loan payments, the insurance and all that type of stuff. Now, his question is, well, what account do I pay it from? The business account or the personal account? For tax purposes, it doesn't matter. Okay, it doesn't matter. For asset protection purposes, I don't think it matters either, because you use that car for personal use and business use. The IRS doesn't care. I don't see how that becomes an issue, because that is not a business asset necessarily. It's a personal asset that you're using for business that you take an expense for. So I don't really have too much of a preference. I would say if you're in a high risk business and you have 80% use business, I would probably have it paid for from the business account. But I don't know, it's a necessity, and I don't think everybody needs to do that in every situation, is paid from the business account. What do you think, Mark? Do you disagree?
Nope,
Concur?
I echo everything you're doing. And I've got an article on autos that really goes through a lot of these issues: leasing versus buying, mileage versus actual, depreciating a non-SUV versus an SUV or truck, bonus depreciation. There's a lot of issues to consider, but I like how Matt, based on the facts given, Matt nailed it. I totally concur with him. And
that's good. Coming from an engine guy to a muffler guy, that's high praise.
Yeah, you might get promoted. If you pay your dues back doing
Maybe
mufflers.
A transmission guy, I can get up to transmission guy.
Yeah, we'll work you up that way. You could be a back seat guy, then you could be a front seat. Fix the little lumbar level.
Okay.
Then work your way forward.
All right.
All right. Okay, you choose another question. I'm almost on this SBA answer, and it's really good.
The SBA is, you get 3 months. I know that.
Well, there's more than that.
SBA loans, if you got a new SBA loan since the CARES Act, you get 6 months.
Mm-hmm.
If you're in certain businesses that have certain codes, because they're more.
I'm going to answer it all. Yeah.
Okay. All right. I knew my answer that was right for that situation of 3 months.
Well, you didn't bring up the new loans before too, so I'm going to hit that as well. This is good. So
okay.
Yeah.
Ben's got a question. This is Ben.
Okay.
He says, I own an S corp that I run my main gig out of. I also own 8 rentals, 3 townhomes, a fourplex, and a 6-bed home. Cool, single family. All with my name on title. All right. I need to transfer them to an LLC or multiple LLCs, or maybe even put them in the name of my wife who runs, excuse me, or in the name of my wife who runs a much less risky biz. All right. Tom Cruise, risky business. Good little shout out there.
Yeah.
Says I have another S corp with another business I run and several other LLCs that I'm in partner with. I was recommended to have my main gig S corp be the partner owner in any other LLC I own. We like that. Makes sense. And let all my taxes flow through and up to my S corp. Okay, got it. I was told the S corp can own part of an LLC, but not the other way around. That is correct. Okay, an S corp can own an LLC, but an LLC cannot own an S corp. What's the best way to simplify my tax filing and decrease my liability across the board? Okay, there's a couple questions going on here for Ben. Let's work backwards. The first is the principle of having one S corp. We like that. I have one S corp. Mark has one S corp. My S corp owns certain things that it gets income from. It gets income directly. It gets income from the law firm that it owns and other businesses that we have that go into the S corporation. Now I've got a tax return on the S corporation. I got to keep books on that S corporation, just like you, Ben. I know it sucks. Now all these other partnerships I've got, which you have too, Ben, you're having separate tax returns and separate things going on. But that's to keep those things nice and clean and tidy for the partnership. But the taxability of that income from those partnerships is flowing all into your S corp, and you take one salary, one net profit or dividend, and you do your own tax planning in your S corp. That is by far the way to go. Trust me, it's better than getting all those K1s out of those LLCs and trying to figure it out.
I love it. I'm on.
All right. Any comments on that before we get to the rentals, Mark?
Okay, go hit the rentals. I'm with you. I totally agree.
Okay. All right. All right. Now, as to the rentals, you got 8 rentals. I do not want those in an S corp. Let's first get that off the table. We don't want them in your personal name either. Okay, that's some liability there. We want your personal assets separate from your rentals. Now, since you're in Utah, Ben, I would actually recommend a series LLC in your situation. If these are Utah properties in particular, we would definitely do a series LLC that your trust would own. You and your spouse should have a trust. If you don't, which is a local living trust, owns that series LLC. You've got enough assets and things going on here, Ben. If you don't have a revocable living trust, give us a call. We can help get the trust set up. But do a series LLC. That one series LLC, we have a show on that specifically too. Go listen to that for the more in depth. But basically, it's one LLC with the state that has individual subseries that would own each townhome. It would own the fourplex. It would own the single family 6-bed. And that way, if something happens on one of the townhomes in this series LLC, the plaintiff can only sue and get after that series. They can't get after the other townhomes in the other series. They can't get after the fourplex. They can't go after any equity in the single family home. But if you just did one LLC, a regular LLC, and you put all these properties, these 8 rentals into that same property, something goes wrong on property number 1, those are all at risk. Okay. All the equity and all the properties are at risk because you're kind of holding all your eggs in one basket with one LLC. So in your instance, because of the number of properties, I would do a series LLC. Utah does allow for that, as does about 20 other states. So that's my final answer, man.
Okay. Now we're going to come back to SBA, but I'm going to jump in on a question here so that I'm participating. I don't want to just be doing research the whole time. The SBA basically kicked out a procedural guidance notice on all these SBA loan payments. And this guidance is this procedural notice 5000-20079 is 17 pages long. And it goes through all the different type of SBA loans and how they're treated with this payment procedure. Did you get the first round? Did you get the second round? How much is the loan payment? How many loans per business? So it's quite involved. So I'm going to just say this. It became effective January 19th. So, I mean, this is just in the last week. I would recommend any of you listening that have a pen or paper handy, please search for this at the SBA website. It's control number 5000-20079. And if you have an SBA loan, it's not written in a foreign language. It's a little wordy, but if you're a business owner getting an SBA loan, you can handle it. open this up and find out where your loan falls in all this. I'm just going to summarize it right now then, Matt, because I don't want to get too far down this rabbit hole. But basically, if you got the first round of SBA loan payments of 6 months, that means your loan was effective before March 27th, 2020. You're now allowed to get 3 more months. So as Matt said, that starts February 1st. That's pretty much across the board, but you could look at the details here. You're only allowed to
get okay.
No,
how much can you get? Is it like up to like $9,000?
Up to $9,000.
Up to $9,000.
And it's only one loan per entity. So Matt and I have an LLC that owns a building with one SBA loan, and we have another LLC with an SBA loan that owns another building. As we talked about, owning your commercial buildings you're in. We can get that deferment or that payment made for both of those LLCs. But if we had 2 SBA loans in one entity, and the second round, it's only allowed for 1 loan per entity. Next, if you got a new loan approved after March 27th, but before September 27th, so you ran out there and got an SBA loan. We're not talking about an EIDL loan or PPP loan. We're talking about just a 504 7A type loan. You can get up to 6 months. So you can get the 6 months. You're like, well, I missed the 6-month one because my loan wasn't in place yet. Well, now it's in place. You can get the full 6 months. Only those that got the first 6 months get 3 months. Then the final kicker is for those of a certain code, an NAICS code, that's a national industry code. If any of you have that national industry code, you can get an additional 5 months. And that is a big deal. So you can get these payments up to $9,000 per month. Now these codes, there's codes 61, code 71, code 72, 213. That's that little code you put on your tax return as to what type of business you are. Now I just Googled that list, and I went to the census.gov NAICS list, and but you've got to kind of go code by code. I'm going to tell you what I saw from this was things like restaurants, entertainment venues, hotels, accommodations. So anything in that realm, if you're close to that and you're in one of those industries picked on, it might be salons, things like that. So go look up those codes, and you can get up to 8 months. Anything you want to add to that? I mean, it is a big.
Yeah, I mean it's automatic for what we saw last round. So we've been told it's gonna be automatic too. So it's not something you apply for. And also I'll say this is not PPP. Okay, this is not the PPP loan you may have got that is SBA related. This is the regular, standard SBA loans we had before PPP came around to buy a business or buy some property or expand your business. Those regular SBA loans that are out there.
Yeah. Okay. So jumping to a question. You answered Ben and Jeffries. Is that right?
Yeah.
I was looking that up. Okay. All right. I wanted to jump on one. I'm sorry you're going to have to hear from me, people, but when you need your engine worked on.
Who are you going to call?
Yeah. The engine guy or the muffler guy? It's just hate to tell you. Okay. All right. Now this is Tina in Maryland. Ooh, Matt. From the stomping grounds. Go, what is it? Tarpons?
Terrapins, yeah.
Terrapins. What's a terrapin?
It's a very fierce turtle. It's a turtle.
I didn't know turtles could be fierce. But it is true. I stuck my hand in my little friend's aquarium because my friend, when I was growing up, had a turtle, and I stuck my hand in there, and it was pretty fierce. They bite hard.
Yeah.
So Maryland terrapins. That's where Matt went to law school. He's famous.
Yep. Turtles, yep. They won the NCAA national championship while I was there. I wasn't on the team.
Part to Matt.
I wasn't on the team, but just throwing that out there.
Yeah, but you were in the crowd. You were the sixth man.
I wasn't.
Yeah, the six-man crowd effect.
I didn't go to games. I didn't even go to one game. That was not my college experience. Was a little different. But that's cool. They were used to be like right now they're terrible. Like football and even their basketball's gone downhill. It's tough being a Terps fan,
okay.
but
all right. Okay. Now Tina asked a question about something I have been buried in every night for like 6 days. It's a massive part of the new COVID relief bill, and many people don't know that they qualify for it. So we almost dedicated the show to that topic. And that's the ERTC, the Employee Retention Tax Credit. Now, why it's important is because under the new legislation, you can do the ERTC and the PPP. You can even go back to 2020 and get the ERTC when it wasn't allowed that you could do both. The test to get the ERTC is easier than the PPP. It's pretty cool, but you have to have employees, and you can't get it for yourself. I know some of you are like, "Oh, Mark, that sounds so good." So if you have an S corp and you're your only employee, or you hire your spouse or kids, blah blah blah, you can't do the ERTC. But if you have any other employee on the books that's not family, this is a sweet credit, and you can do it on top of PPP. Some people aren't even doing PPP, and they're just going to the ERTC. So Tina asks, for the new ERTC that was passed in December, it let you retroactively go back into 2020 and claim the ERTC, which is up to $5,000 per employee. Otherwise stated, 50% up to $10,000 of annual wages for all of last year. So every employee last year, outside of your family, that you paid at least $10,000 to, you're getting a check for $5,000. Big deal. It's wonderful. I had a client with like 60 employees. Times $5,000. Do the math. Okay. My question is, I got PPP in 2020, but that last 2 months I used all in second quarter. Can I file 941X for third and fourth quarter and claim ERTC? Or I can only use ERTC for 2021 only. We really appreciate both of you. Thank you so much. Well, Matt, look, that was nice. She mentioned you.
Oh, thank you.
She said both of you.
Thank you.
Yeah,
thanks,
we
Tina.
appreciate the muffler guy as well. That's really what she meant. All right, sorry, we're going to beat that up. That's why. What?
I said, that's what I heard. I heard that.
Yeah.
That's what I heard.
Yeah. Okay. Now, everybody listen, this is a really good question, and it's tricky. Matt, in fact, this is what I was up until my brain turned to mush at about 2:30 last night. I was working on Tina's question from about 1 to 2:30 a.m. on this very question. Some of you are like, you have no life. You are certifiably a geek. So, yes, Queen's Gambit, me, yeah. Okay. So here's her question. And let's rephrase it so everybody can get their head around this. One of the rules with ERTC, even if you go back into 2020, is you can do both of them, but you can't use the same payroll dollars for the ERTC and PPP. So I was creating this massive little table to give examples of what this means and how you have to be tricky in taking advantage of both. Now, I'll do my best here. Let me answer it this way. First, in concept, then I'll maybe do a numerical example. Tina said, I used the PPP all up in second quarter of 2020. All right, cool. She says, can I then do the ERTC for third and fourth quarter? Yes, because you're not using any PPP money in third and fourth quarter. So you could do both strategies. You just can't use the same payroll dollars to claim both benefits. And so in Tina's question, she makes it really easy on me. She says, I used PPP in second quarter. I did it in third and fourth quarter, so I can go back and get ERTC for third and fourth quarter. That's right. But Tina, you're using a third and fourth quarter analysis when last year is an annual analysis. Well, in 2021, it's a first and second quarter analysis. So for example, everybody, let's say Tina's payroll was $50,000 and she used PPP money to pay $30,000 of it in second quarter last year. Well, look at the rest of her annual payroll for the year. It was $20,000. 50 minus 30, she had $20,000 left of payroll, and that's what she spent in third and fourth quarter. Well, if those were two employees, because she can't count her own payroll for ERTC, but she can count her own payroll for PPP. See the trick? So she'd say, well, I had $20,000 worth of payroll. and I can get up to 50% up to 10,000 per employee. I don't care if it was third or fourth quarter. I care how much payroll you used for that employee for the year and how much of it was used for PPP versus ERTC. And so you're going to do some math there. Now, I was creating spreadsheets, like I said, at 1 a.m. because there's so many variables. But I'll leave it at that. I'm getting too technical and I'm a nerd. But then Tina's final question, or I can only use ERTC for 2021. No, you can use ERTC for 2021 and ERTC for 2020. You're going to look at it a quarterly basis, which is 70% of 10,000 per quarter in 2021, where it's 50% of annual wages in 2020. So it gets better. It gets better. And if you use us, I throw in a ShamWow towel. So that's a little infomercial.
ShamWow, huh? Okay.
Yeah, infomercial throwback there. It gets better. It gets better. Okay, so anyway, Tina, you're on it. Now, believe it or not, I'm not kidding. After this podcast today, we're doing a training with our attorneys on this very issue. And they all are up to speed on this. And we're just making sure that everybody's on the same page, because this is a moving target. New legislation or new notices come out from the SBA almost every week. You saw that with the last notice we talked about. So if you need a consult, talk to your accountant or lawyer if they know what they're doing, or be patient and set up an appointment with us, even if it's 2 weeks out. You can claim this well into first and second quarter. You don't have to have an appointment now or you're going to miss it. You can still do the math and make this work. PPP applications are until the end of March. So you have all of February and all of March to apply for PPP. But Matt, you're going to love my analysis later. It's pretty cool.
All right, cool.
I can't wait to tell you. It's pretty cool.
All right. Yeah, this ERTC is that's turned into a little more popular, I think, this go around than last. So it's one you really want to, if you're like, didn't track too much on what Mark was saying there, look into ERTC more. If you have other employees in particular, this could be a really powerful tax credit. All right, this is my last question. This was from Stevie. And Stevie was cool. She shared our podcast, I know, on her social, and gave us a pretty good shout out there, which was cool. So she's a fellow podcaster and virtual CFO. So we always love some other pros out there giving us praise. Mm-hmm. But she said she had a good question that came up on our webinar recently. We did a webinar on COVID relief, by the way, with the entrepreneur. You can go find it on entrepreneur.com if you want to get kind of a full deep dive in all the different things on COVID relief from last month's bill. She said, I have several clients that started a business in 2020 and we're trying to determine whether or not they qualify for the new PPP. Several of them formed in early 2020, January, and incurred expenses in the first few months, but didn't start selling products or services until March. I watched the webinar, and I know Mark mentioned he was planning to write a blog for businesses that started in 2020. Is this available? Then she talks about how she's a fellow podcaster and is going to spread the love of our show to others. Okay, good news, Stevie. Quick update on that. And Mark, you can elaborate if you've...
Yeah, I pulled up the SBA application for the second draw for this very issue.
For those that are new businesses that started in 2020, you can get PPP, the first variety of it. Okay, this is nice because you don't have to show the loss of income from 2020 to 2019. You get to just qualify under the, the lower threshold of business uncertainty, economic uncertainty makes loan necessary. So for those that started in 2020, you had to have been set up though by February 15th, and you use your 2020 average payroll numbers. Okay. Now the first round, you couldn't do this. They clarified this though in the legislation. You can, businesses start up in 2020 as long as they were set up by February 15th or established, can get this first round of PPP, and you're using 2020 average payroll numbers. So for that, your specific question, Stevie, if someone that formed in January but wasn't doing business until March, they're actually the perfect one that's going to fit into this. Let's say someone didn't start anything, they didn't even set up their entity or anything until April. They're not okay. They would have had the business had to have been started by February 15th.
Now, I want to throw this out too, and I'm right now, and this is good for many of you to read. You can go straight to it on the web. Google SBA Form 2483 SD, Sam David. Now, this is the Paycheck Protection Program second draw application form. I read this kind of stuff all the time, and sometimes I just can't get my head around it. This application's not bad. In the directions, or the instructions, I should say, after a 2-page form. I mean, there's a very, very simple form in concept. I should say 3 pages. The second 2 pages are just check boxes. But the instructions that start on the 4th page, they talk about when you were in operation. And one thing that in that question that you asked that Matt just read, you said they formed the entity, but they didn't have sales until later. Just forming an entity is not being an operation. You got to have sales. So operations mean that you could have been a sole prop, cool, but you had to have been making sales by February 15th. Would you concur with that, Matt?
Yes.
Okay.
Yep.
Okay.
That is what the statute says. It does say operational, not established. So good clarification.
And right there in the first page of the instructions, and it's not bad, again, it says right in the middle, there's 4 bullet points. For all loans, the appropriate reference quarter depends on how long the applicant has been in operation. So for entities not in business during the first and second quarter of 2019, but in the third and fourth quarter of 2019, here's the test. For those in da-da-da. So you got to look at when you were in operations. Now, let's step back for a minute. Everybody take a breath. And I'll finish on this note too. Some of you are a little pissed. I know. You're mad because you're going, hey, I started my business in the middle of 19, or when COVID hit, I went out and started a business. Why can't I get more help? Now, Joe Biden and the new administration might throw you a bone. I don't know. They're already talking about another package of relief. But the main concept of their first and second round of the COVID relief was, we want to help businesses that were affected by COVID, which means you were in business before COVID hit. That's what they're saying. If you had employees, if you were in business, we've got unemployment for those out there that had jobs. But for those of you who are in business, and see what they're trying to say, you were in business plugging along in 19 or before, and then COVID hit, boom. What can we do for you? Their goal was not, oh, for all of you that were on unemployment and now you want to start a business, we're going to throw money at you too. No, that's not the goal. Is that okay? I'm not sounding too mean.
Yeah. No, you're totally right. I mean, that's how the cookie crumbles, as they say. But but also this is going to help some people, because there's a lot of people that set up in, let's say, 19 and it was their first year, and they're like, well, I was a sole prop, but I didn't have any profit. I didn't make any money. I had all these startup expenses or whatever, or I was an S corp and I took a really small W-2. So there was nothing to really get on a PPP. Well, now you can get a second shot at this. If 2020, you did have some income now, which is odd, but that's just the way it was going to work, where you can use your 2020 numbers now. If you were in operation by February 15th, 2020, to now get PPP again under the original test, not having to show a loss of revenue from 2020 versus 2019, which you have to do for the second draw loans, but just under the original test of economic uncertainty makes the loan necessary.
Yeah.
So,
and
all right.
Yeah, I love it. And gosh dang it, I was going to say something on that note. I liked the way you phrased that. Is that when Matt said what was odd, he said, how did you start in 19 and not make money, but in 2020 you did? What was funny, I don't want to use that word. What was interesting is that when COVID hit, it created this whole new winners and losers of types of industries. Like people that were doing home delivery, web sales already, when COVID hit, boom! Yeah. There's just like freaking, oh my gosh, COVID's the best thing that could have happened to my business. And I hate to say it that way, but some experienced that. Look at Zoom. Zoom was behind GoToWebinar and Skype, and I mean they were just a small player, really, relatively, when it comes to market share. And when COVID hit, they were ready. Freaking the Zoom platform was freaking awesome. Zoom is off the chart now, and so it's common. Some people did have a good 2020 and a crappy 19, and if you didn't get the first PPP, you might be able to get the second PPP because you never got the first round. And that's the weirdness of this. But Matt and I are continuing to write articles on this and try to help. The topic's not over. I know some of you are sick of it, but especially you landlords, hang in there because we're going to see more landlord relief come too. So, all right, Matt, take us out.
If you want to get updates on some of these topics, make sure you're signed up for the newsletter, which you can get at mainstreetbusiness.com, mainstreetbusiness.com. Also, if you want to submit a question, if you just think of one, and you're like, God, this would be a great question for the show, go to mainstreetbusiness.com, hit submit a question, and it'll track them all in there. You can see other questions other listeners are asking, which we just went through today. And thanks so much for hanging in there and listening to this. We really hope that you learn something that can, help you save taxes, better live the American dream, make life a little easier. That's really what we're going for here.
I love it. And we're having a special on new mufflers this month. And if you need one, stop in at your local auto parts for a muffler exchange.
Yeah.
See you next week.
Thanks, everyone.